January 9th. As we come into tax season, here are some tax tips for Canadian taxpayers. This year, with the record levels of inflation that we've experienced and the continued rising costs of living, there are ways to avoid overpaying on your taxes. So, organizing your finances and preparing your taxes in advance will give you ample opportunity to look for tax deductions, tax credits, and other rebates or benefits that will help lower your tax bill and keep more money in your pocket. So, tip number one, compile all your income slips, such as your T4, T4A, T4E forms, T4 RRSP. Sorry, I got a cat trying to walk across the computer. So this past year, CRA has been especially focused on reviewing or reassessing missed or incorrect reporting of T4A slips, T4A income. So this is especially poignant. I got a second cat trying to interrupt Tax Tips Tuesdays. This is especially important for self-employed people, sole proprietors who have some of their income reported on T4A slips. It's very important that you enter that into the tax program correctly. And of course, failure to report your income on the correct lines can result in CRA reassessing you and a new tax amount owing. So basically what would happen is you would end up potentially paying tax on the same income twice, and we don't want that. So tip number two, investing interest. Having some challenges here with the cats in my phone. Investing interest. When can you claim it as a tax deduction? So if you have a mortgage on a rental property or a loan where you use those proceeds, that loan money, to purchase investments that are in non-registered accounts, so not in your TFSA and not your RRSP or the new First Home Savers account, you can deduct the interest that you paid on that loan on your tax return. So key there is non-registered accounts. So the same if you're self-employed, you can claim a portion of your mortgage interest in addition to the rest of your housing expenses as part of your office and home deduction. So tip number three, if you are self-employed, how much should you be saving for taxes? As a tax professional, we get asked this question all the time. So you as a taxpayer are of course responsible for saving the money to cover your tax bill. And it should be paid by April 30th to avoid interest, especially with the interest rates going up. CRA is now charging 9%. A year and a half ago, it was 3%. So it's gone up quite significantly. So keep in mind that if you are a sole proprietor, you will almost always owe money, even if you have extra tax credits and deductions, such as tuition, childcare, or being a single parent. This is because in addition to the federal and provincial taxes, you are also responsible for almost 12% in Canada pension plan premiums. So no matter how many deductions or credits you have, the CPP is always there. So therefore, you will almost always owe money as a self-employed sole proprietor. Tip number four, I guess I should say with tip number three, how much money you should be saving. If you are not GST registered, I usually recommend saving 20% of your gross, 15 to 20% of your gross. If you are GST registered, 20 to 25% of your gross. So that's kind of a guideline. That should be kind of the minimum that you're saving. If you, but you should talk to your tax professional to see what the actual percentage for your particular situation is, as it could be more or it could be less. Tip number four, as a small business, a sole proprietor, you have more deductions available to you. I often see people overlooking or not claiming many different types of deductions that are available to them. So as that small business owner, sole proprietor, you can deduct several different types of business expenses: meals, advertising and promo, office supplies, travel, vehicle expenses, tax fees, tax prep fees, other legal fees, insurance, association fees. There's the list is almost kind of endless depending on the nature of your business. So the tax tip is that it helps to keep track of all your potential operating expenses, your potential business expenses throughout the year, so that when you get to tax time, it's a lot easier to put them into your tax program or give them to your tax professional to see what can be used. The most often things that I see that are overlooked are things like bank charges, miscellaneous, office supplies. You went to the dollar store or the Walmart and picked up, a pack of paper or some pens or something like that. And then advertising and promo things related to your business. Those are the most common ones that are forgotten about. And then tip number 5, maximize your tax savings strategies through investing. So with TFSAs, you pay taxes on the money before you contribute to your TFSA, but the gains that you get from investing in your TFSA are never taxed. With RSPs, you can reduce your taxes owing when you file your tax return, and you pay the taxes later on in life when you withdraw the money that you contributed to your RSP. So RSPs are paid with after-tax money because you pay the tax later on in life when you actually withdraw it, when theoretically you are in a lower tax bracket. So to get the best result, you should consider your current and projected income and your investment timeline when you're deciding where to invest your extra dollars: TFSA, First Home Savers Account, RRSP, or non-registered accounts. So I hope you enjoyed this week's Tax Tips Tuesday with me, Christine Walters. Come back next week for another tip.